It's really easy to see a conflict happening thousands of miles away and think, well, that's over there. It doesn't really affect me. But what if I told you that a single blockade in one tiny little stretch of water could directly lead to you paying way more for gas, for your groceries, and could even push the entire global economy right to the brink of a recession? Let's break down exactly how that could happen. Just look at this number for a second. 22 million. It's the key to this whole story. That's what we're talking about. 22 million barrels of crude oil that the entire world depends on, all squeezed through one of the most volatile regions on the planet. And it's this one vulnerability, this one single point of failure, that could set off a massive global chain reaction. Right. This is the big question. It's what keeps economists and world leaders up at night, and today we're going to answer it. We're going to go step by step and show you how a regional crisis can very quickly become everyone's problem. Okay, so to get this, you first need to look at a very specific place on the map, the Strait of Hormuz. I want you to think of it as the world's energy jugular vein. It is, and this is no exaggeration, the single most important oil choke point on the entire planet. So to put this in perspective, the world uses about 105 million barrels of oil every single day. And just look at this. Roughly 20% of that, those 22 million barrels we just mentioned, has to pass through this one narrow strait. A full fifth of the world's daily supply is totally at the mercy of what happens right here. Now, here's where it gets really interesting. The global oil market was already kind of walking a tightrope before any potential conflict. The whole system just didn't have much slack to absorb a major shock. It was already fragile. And there are two big reasons for this fragility. First off, for years now, there's been some serious underinvestment in new oil production. With the global push for an energy transition and a lot of aging infrastructure, there just isn't a bunch of spare capacity waiting to be turned on. And second, you've got OPEC+, which basically acts like a cartel, and they've been deliberately managing production to keep prices high. So what does that mean? It means the market was already tight, with almost no room for error. So you've got a market that's already on a knife's edge, and this is where that first domino falls. If the Strait of Hormuz is blocked, it doesn't just cause a little ripple. No, it triggers an absolute tidal wave through the global energy market. And the sequence of events is fast, and it is brutal. The second the strait closes, bam, 22 million barrels of oil per day vanish from the market. Now, there are a few alternative pipelines that can bypass the strait, sure, but they can only handle about 5 million barrels a day. That leaves a massive 17 million barrel hole every single day. So the next step is to release strategic reserves. But that's just a band-aid. The world then scrambles to find oil anywhere else it can. But while all of this is happening, pure panic and real scarcity cause prices to just spike. In response, you'd probably see nations coordinate this massive release from their strategic petroleum reserves. Let's say they all agree to release a huge amount, say 400 million barrels. I mean, that sounds like a lot, right? But here's the catch. When you're losing between 17 and 22 million barrels a day, that massive release, it would be completely gone in about 20 days. It buys you a little bit of time, but very, very little. And you can bet that as the markets watch those reserves just drain away, the price of oil would probably climb even higher. So you might be thinking, well, why can't other countries just pump more oil? If only it were that simple. See, ramping up production from existing fields or new ones can take months, sometimes years. Plus, and this is a big one, not all crude oil is the same. Refineries, especially in Asia, are set up for a specific type of light crude that comes out of the Middle East. You can't just flip a switch and start using a heavier oil from, say, Venezuela. It's not a quick or easy fix. I mean, the situation is so serious that we've even seen sanctions on Russian oil get lifted just to try and stabilize things. And this is how an energy crisis starts to morph into a full-blown economic crisis. This is the part where a problem that started over there starts hitting everyone's wallet right here at home. This right here is the classic economic nightmare scenario. A huge spike in oil prices immediately drives up inflation. Everything from shipping costs to the plastics in your phone gets more expensive. Now, to fight that inflation, central banks really only have one main tool. They raise interest rates. But higher interest rates make it more expensive for businesses to grow and for you to borrow money. This is designed to cool down the economy, to slow growth. But if they push just a little too hard, it can easily tip the whole world into recession. Okay, so with any major economic shift like this, you're going to have financial winners and losers. For investors, this kind of volatility creates both immense risk and, frankly, potential opportunity. So let's take a look at which sectors might weather this storm and which ones could be directly in its path. The logic here is pretty straightforward. On the at-risk side, you've got sectors that are super reliant on fuel, right? So airlines, cruise lines, obvious. You also have consumer discretionary and luxury goods. I mean, people stop buying expensive handbags when they can barely afford to fill up their car. And any industry that uses a ton of energy, like glass manufacturing, their costs just explode. But on the other side, oil producers located outside the Middle East and North Africa, what we call non-MENA producers, along with the companies that service the oil fields and defense contractors, they could all see a big surge in interest. Now, here's a little paradox for you. For investors, it's actually the high-cost producers who could benefit the most. Think about a U.S. shale company or a Canadian oil sands company. Let's say it costs them $79 to get 1 barrel of oil out of the ground. If oil is selling for $80, they make a $1 profit. But if that price suddenly shoots up to $90, their profit just jumped to $11. That's a tenfold increase. Their profit margins absolutely multiply in a high-price environment. And that really brings us to our final thought here. While, sure, specific companies or maybe certain sectors might profit from all the chaos, a global energy shock that triggers a recession would, in the end, affect everyone. Higher prices, job losses, economic uncertainty, those things don't respect borders. It really makes you stop and think about just how fragile our interconnected global system truly is.